Hello. We're now going to think a little bit about Chapter 14. And when we think about this, this is the management accounting chapter, the introduction to management accounting. I thought it would be a great thing to use a case study to explain management accounting. Well, a few overview type things before we actually start to look at the case study. First, a fixed cost. We call this a cost by behavior, and a fixed cost doesn't change with a change in volume. So for example, if we buy one pizza oven or one rocket ship, we have a price that we have to pay for those things. It doesn't matter if we make one pizza or if we have one person fly on the rocket ship, or if we make 1,000,000 pizzas and have 1,000 people fly on the rocket ship, the cost doesn't change. On the other hand, variable costs by behavior do change with the change in volume. You might think, for example, of goods. Like, for example, if we make pizzas, the cost of the dough changes with every pizza we make. The cost of the tomato sauce changes with every pizza we make. If we have direct laborers that do nothing but make pizzas, or nothing but fly rocket ships, then every time there's another sale, this person spends more time, and there's more cost. Well, we could consider costs by traceability instead of by behavior. And so here, we might have direct costs, which are the direct costs of making the product. We think about the pizza example again. The cost of the dough, the salaries for the laborers that make the pizza, the cost of the tomato sauce, these are direct costs. The cost of the oven, or the cost of the company president, might be a support cost. This is one way you can approach your case study. So in the case study, first requirement, part 1, you needed to put the 10 costs and break them down by whether they're fixed or variable. Shouldn't typically be both. There's one exception to that. And direct or indirect. So you could come up with a chart like this. And I'm just kind of limited by space here. You could do this all on the same page if you want. But I considered the ship a fixed cost, not a variable cost, because again, it doesn't matter if I take one passenger or 10. The ship costs the same amount. Doesn't matter if I fly it once per year or 100 times per year, it's the same cost. Notice though that I decided that $4 billion that the ship cost, it wouldn't benefit only 1 year. Instead, the ship, by my estimation, will last 10 years, and therefore it's only a cost of $400 million per year. That turns out to be important later on when we're trying to price the product. Also, I've said the ship is an indirect cost. The hotel. Unfortunately, this is a 1-year cost. We can't divide this by 10 years. It's $1.35 billion every year. I believe it's also a fixed cost, not a variable cost. We have to pay it whether 1 or 1,000 travelers go up to the moon. It's also an indirect cost. Wages, for purposes of requirement 1 or part 1, I've shown as variable, and yet later you'll see when I was doing my pricing calculation, I went back and called it an indirect cost. You'll notice here I said it's direct. The wages are 1.1 million, 110,000 divided by 10 employees, or sorry, multiplied by 10 employees. The food is variable and is direct, and the case study tells you it costs $630 per person. Now, maintenance is the one item in the case study that has both a variable and a fixed component, each $40 million per year. So this is both variable and fixed, but I am deciding it's all indirect. It doesn't directly relate to any particular traveler's space flight. The day ship for the day excursions, to me, is also a fixed cost. And again, I divided the $400 million by 10 years and came up with a $40 million cost per year. I also decided that this is an indirect cost. The suits, $1.8 million per year. I decided those were fixed. I decided that because each traveler does not get a new suit. The suits are very expensive, and unless the travelers break them up, we hope they'll last for other passengers. I also said then that the suits are an indirect cost. The devices, the electronic devices, I said are also fixed costs, not variable, because we hope more than one traveler uses them, and they're indirect costs. The furniture costs $1 million. It goes inside the ship and the hotel, probably more the hotel. But I don't believe that these have to be, this money has to be respent every year. I think the furniture will last 10 years. So I took the $10 million furniture cost, divided it by 10, and came up with $1 million per year. Finally, the insurance costs are $500 million per year, and they can't be spread over other years because it's the same cost every year. So here I've considered it a fixed cost and also an indirect cost. At this point then, I'm trying to figure out price per traveler, but what I have on this page is the costs of all the items that I'm considering indirect. So here I have the annual ship cost. Notice it's not the whole ship cost. The annual hotel cost, which is the whole hotel cost. Annual wages, annual maintenance, both fixed and variable portions. Day trip. The suits, although I decided that the $1.8 million doesn't have to be spent every year. That probably on the balance, suits only have to be updated once every 2 years. I put the whole devices cost, $150,000 per year. The whole furniture cost of $1 million per year, not the whole $10 million, because again, I think the furniture will last 10 years. And all the insurance cost of $500 million into the basic costs. Now I want you to notice I considered these then indirect. I decided that indirect was a more important distinction for pricing than whether or not the costs were fixed or variable. This is unique to this case. Other cases, fixed costs and variable costs may have a lot more to do with how we price products. So here, I added all those numbers up that were on the last page, and I came up to $2,373,150,000 in total. That's the total cost. And I divided it by the annual number of travelers. Now, how did I get that? Well, the case study says that 10 people can travel per trip, and it says that the company only has one ship. Now, we're going to have more than one flight per year. The case study says that the flight will last 2 weeks. So at most, we could have 26 trips, 52 weeks a year, divided by 2, because each flight takes 2 weeks. So we could have 26 flights a year. But then I decided there'd be a 2-week period, maybe around the holidays, where we did maintenance on the ship and on the hotel. So I decided there were only 25 trips per year, 10 people on a trip. So 10 times 25 is 250. So I divided, you could look at it as spread, the cost or the indirect cost for everybody by the number of travelers. And I came up with an indirect cost per traveler of $9,492,600. Yes, this is a very realistic price for how much it might cost somebody to go in space. But again, still we're at the cost, we're not at the price. So after the indirect cost per person of $9,492,600, I added in the direct food cost. Then I took those two numbers, which I don't show you on the page, I added them up, and I multiplied them by 10% to come up with a profit. My business is in business to make a profit. I'm not going to break even. So whatever the costs are to send these people into space per traveler, I want to add $949,323 or 10% as my profit. So The rough price I would charge is $10,442,553. Now I want you to understand everything in slides A through F, the last slides, was an estimate. So we're not going to charge a rough raw price like $10,442,553. This is not precise data. It was just an estimation. So I'm going to round it. And in my case, I round it to $10,500,000. I'm going to leave you with this. Is this realistic? Is this how space travel will start, for people on Earth? And my answer is you betcha. There's a historical model out there. When electric power was first founded around the turn of the 20th century, Thomas Edison, who went on to found General Electric, was commissioned by J.P. Morgan, one of the richest men in the world, to build a generator for his house. There was no market for electric power other than that. Edison built a generator the size of Morgan's house and put it under the ground in New York City to power Morgan's house. Morgan believed, and he was correct, that once he demonstrated the benefit to electric power in a house, everybody else would want it. That's true. After him, a number of wealthy people started buying electric power for their houses. But then something else happened. Governments decided that they should buy electric power and use tax money from their residents. And in turn, they could provide the residents electric power for the tax money and not charge them extra costs, or charge them small extra costs, as we see with a monthly power bill. Now, you may not think the power bill's small, but keep in mind, you don't pay for all the electronic transmission, you're not buying towers and everything like this. You're paying a small charge in addition to some tax money, but a lot of the tax money for the electric power infrastructure was spent decades ago. So finally, I do think a few poor people or middle income people will go into space even at the early days. These will be people who are scientists and doing very well at universities but not rich. Several universities have large endowments, and I think they'll use their large endowment to send some of their best researchers into space, and some of them will be very middle or lower income type people. As time goes on, I expect the cost of space travel to come down, and you'll see more and more people going to space. But when the first few companies do it, like the Eastern Shore Milky Way company in my example, you can bet the price per traveler is going to be high. Take care. Let me know if you have questions.